The first critical market challenge is one you face before a single trade is taken. Get this wrong and you could be trading into a dead end without even knowing it. The first market challenge is selecting the right product to trade. In this video, we're going to show you what happens to traders that choose the wrong product and how it nearly guarantees failure. Next, we'll reverse engineer what it is about a good trading vehicle that makes it good to trade. We'll define the characteristics that you can look for, plus we'll show you some examples of how your trading game plan affects what products you can trade. Speaking with traders every day, we see that more frustration and loss of capital in trading is actually the result of trading the wrong product. When we say the wrong product, we don't mean that there isn't somebody out there making money in that market. Trading is a zero-sum game, so if a trader can lose money in a market, someone out there must be profiting somehow. In many markets, however, the only ones that do have a chance to make money in the long run are professionals like market makers. What's worse is that many traders involved in these markets aren't aware that they don't have a chance to win. If you ever had the feeling that your account is taking one step forward and two steps back, chances are you're trading in the wrong product. It's impossible to succeed in these markets because they lack the two things you need in order to win: liquidity and volatility. Liquidity is generally understood as the ease at which you can enter and exit a market. For us, what that really means is how much it costs for you to get in and out. Illiquid markets are characterized by wide bid-offer spreads, so when you make your decision to trade, the actual price you get can be a few cents away. That additional cost makes it that much harder to be profitable. And when you trade the wrong product, that's not just going to be a one-time thing. That additional cost is there for every trade on the way in and on the way out. You might say, what's the big deal with a few cents? We're trading to make thousands of dollars, and if you know what you're doing, the cost should be negligible. That's true if it were possible to be right on every trade. But what's more realistic is you'll have some winners and some losers. If you've got a good trading system, you may even have a high winning rate, with more winners than losers. But after commissions and slippage eat away at the gross profit, the losers will outweigh the winners. If you see it this way, it's clear that trading illiquid markets doesn't give you the best chance at success. What's dangerous is that it's not always obvious that you're trading in one of these markets. We hear traders say all the time, "I won on the trade, but I gave it back in commissions." There are two easy ways to recognize an illiquid market before you trade. The first is to look at the bid-offer spread. Spreads are as tight as they've ever been, but they're still wide markets. You can also recognize illiquidity in the charts. It shows up as gapping between the close of one bar and the open of the next. If the chart you trade features frequent gapping, you may want to reconsider trading it. The next characteristic we need to see from a market is volatility or price action. This is particularly interesting because many traders are actually taught the opposite, to fear and avoid volatility. But when you consider the opposite, a market that is not volatile, you have an asset whose price is not making a move higher or lower. That's not good for you as a trader, because while there isn't a chance for you to lose a lot, your winning trades will never be big enough to satisfy you, while you still have some losing trades. Factor in the cost of trading, and you realize to give yourself the best chance to be profitable, you need a market that provides enough opportunity for you to overcome your costs and then begin to profit. Once you understand volatility this way, it should be clear as to why we want to trade the most liquid and volatile product that we can. But it can still mean different things to different people. Market conditions too are dynamic, and the products that are tradable today are not necessarily going to be tradable a few months from now. That's why it's important for you to be able to determine tradability for yourself. Intraday E-mini traders have the advantage of having the VIX calculated for them, but a more intuitive method that anybody can use for day trading is finding the daily average true range. The ATR corrects for overnight gapping and shows us on average how much price action a product gives us during the trading session. Compare it to your costs and you can see dynamically whether a product provides enough opportunity to overcome your costs and profit. Swing trading and position traders trade less, so the cost of trading is less prohibitive. But if you're trading a product that hasn't moved for a long time, you're waiting for a long shot to occur. Along the way, there can be whipsaw and losing trades, and there's no limitation to how long your capital is tied up. Watching a position bouncing between profit and drawdown is torture. If this is happening to you, you could find a different product to trade, or you can consider trading it more actively. In 2011, the S&P opened and closed unchanged for the year. Yet there were tremendous opportunities if you knew how to take advantage of them. I hope this video has helped you to see why trade selection is so important and that you learned some methods that professional traders use to ensure a chance at success. Review your trade selections and join us for the next video where we'll begin to show you how you can gain an edge over your competition.